What has better returns, the stock market or real estate? If you keep your money in the stock market for 20 years, the probability that you lose money drops down to near zero. Is the same thing true in real estate? How long do you have to keep your money in the housing market for your probability of losing money to go down to zero? I went down this huge rabbit hole and did this giant analysis of which is better, the stock market or real estate, and I have the results, which I am going to share with you in this video today. Which is riskier? Which has better returns, the stock market or real estate? And to answer this question, I'm going to use my handy little digital whiteboard here. When you talk about the stock market and averaging and measuring returns, it's actually pretty easy because the data is fairly straightforward. But when you talk about real estate, it's a little bit harder because most people who buy real estate are just buying it as a homeowner. And so that was the first thing I looked at. What happens if you just buy it as a homeowner? But then I started thinking, we're talking to investors here. What happens when you add in not just property values and appreciation, but the things that investors really care about, like cash flow and your loan pay down? And so I did all these different analyses and I compared these different scenarios in the housing market to that of the stock market. I had to make some assumptions about what was going on in the housing market. And so first thing you should know is that I used the median home price for every year back to 1970. So I did this analysis and looked at how the housing market has grown and changed over the last 52 years. And I did have to stop at the end of 2022. There's no 2023 data in here, just so you know that. The second assumption I made, you'll see here, is that I assume because most people listening to this, and I am a real estate investor, that you're putting 25% down on your property. I put an average cash on cash return at 6%. The cash flow growth rate, so basically rent, growing up at 2%. And amortization, which is your loan pay down, at about a 3% annualized return. Those are all fairly conservative estimates for real estate investors, but I wanted to be conservative just to make sure that this analysis wasn't overly biasing real estate because I am a real estate investor. So if you are an investor, you probably know these are pretty conservative numbers, but I did that on purpose. So you'll see where this comes out is really, really interesting, and it depends on those different scenarios and different types of involvement in the housing market that I was talking about. Okay, so now that we have our assumptions out of the way, let's jump on to our first analysis. And the first thing that I did was try to answer that question because I saw that chart about how it takes 20 years being invested in the stock market for your probability of losing money to get down to zero. And so what I did was, first and foremost, I tried to replicate those numbers, and I was actually able to do that exactly. So I took inflation adjusted numbers for the S&P 500 because as investors, we want to inflation adjust our figures because that's super important that we use normalized dollars. It does take 20 years of being invested in the stock market for your probability of loss to go down to zero. I was able to replicate that. Then I created 4 different scenarios for real estate. And this is important because in real estate, people buy for different reasons. Homeowners have different income and different return potential, different risks than investors. And so what I did was, first I looked at nominal home values. That's basically the price of a house without adjusting for inflation and how that compares. Then I did real home values, which is the same kind of thing, just looking at price appreciation, but adjusting for inflation. Then I did the same thing, real home values plus cash flow, again, at this 6% rate here. And then the last thing I did was the whole investor package, which is inflation adjusted home prices. So that's your appreciation, then added in your cash flow, and then added in amortization. How would that compare to the S&P 500? And what I found, and you can see in this chart, is that all 4 of those scenarios are pretty significantly less risky than the S&P 500. If we look at this number again, remember, the S&P 500, the probability of a loss it takes 20 years to get that probability of loss down to zero. That's not bad, especially if you start investing in the stock market when you're really young. Hopefully you're investing for a 20-year time horizon. Probability of losing money, though, if you do inflation adjusted home. So basically this is kind of like the homeowner scenario. Like if you just buy a home, hold on to it, you're not getting cash flow, you're not getting loan pay down, then, and you are adjusting for inflation, that would take 16 years. So that is still better than the S&P 500. There is less risk that you will lose money over time just buying a home, even in inflation-adjusted terms, than in the stock market. When you add in cash flow and amortization, as you can probably imagine, the probability of loss goes down even further. When you add in cash flow, it would be just 12 years until your probability of loss goes to zero. If you add in that loan pay down or amortization, it goes to 10 years. So when you take advantage of all of the things that a real estate investor can take advantage of, the probability of loss is 10 years, and the S&P 500, the stock market, is 20 years. So it's half as much. So that is a really big win for real estate. The one thing I did add in here, just because I was curious, was how long it would take in nominal dollars. So that's non-inflation adjusted dollars. And as you can see, it would take just 7 years to get your probability of losing money down to zero if you just do non-inflation adjusted dollars. I don't recommend that as an investor. I think it's important to inflation adjust all of your investments, like I've done with the first 4 data lines here. All 4 of these are inflation adjusted. This one, I was just kind of curious, like as a homeowner, if you bought a house, how long would it take for you on paper to not lose money? And it's only 7 years. It was a lot faster than I thought. In this first analysis, which is how long does it take to get your probability of loss down to zero, real estate is the hands down winner. But this doesn't really factor in the potential for reward, right? We're just talking about the probability that you lose money. We're not factoring in this first analysis whether you can make more money in the stock market. And so in the second analysis that I did here, I took the average returns over a 30-year time horizon. So I went all the way back to 1970 and looked at how, if you started in 1970, what would your returns look like for the next 30 years? If you started in 1971, what would your returns like for the next 30 years? 72, 73, I did that for all of the years, and then I averaged the results. I added in, I inflation adjusted everything. Even for the S&P 500, I added in inflation adjusted dividends. So I did the whole thing. This was not like a simple analysis. I really went for it. And what I found was that real estate, again, tends to be better, but only if you're a real estate investor. So this yellow line, which has the lowest gains of all of them, is your real average property value. So this is inflation adjusted, just how much your property price goes up over time, not factoring in cash flow or loan pay down. As you can see, the returns over 30 years average to about 60% over 30 years. So that's not very good. I mean, it's better than inflation. So it's better than keeping your money just like in a bank account that's not earning any interest, but it's not that much better. So like, that's why a lot of people say that just buying a house isn't a great investment. It is if you're not inflation adjusting, but you should be inflation adjusting. And as you can see, it's not that great of an investment. But when you go next up is the S&P 500. So as you can see, when you inflation adjust the S&P 500 over 30 years, it averages, 300% over those 30 years, which comes out to about a 10% return when inflation adjusted and including reinvesting your dividends back into your portfolio, which most people do. So that's pretty good. I mean, that's a really solid return. But it is not as good as real estate investing. So when you add cash flow into real estate investing, it gets your returns over those 30 years up to about 520%. And then if you add the loan pay down in on top of that, which is another benefit that real estate investors get, it is over 600% here. This doesn't even factor in the tax benefits that you get from real estate. And so from this analysis, I think I can conclusively say that real estate investing earns better returns than the stock market, and it is less risky than the stock market, at least over the last 52 years. Now, some people are great stock pickers and they can probably beat these averages, but I'm just using the S&P 500 average. And I also want to note that if you are just buying real estate for appreciation, it is worse than the S&P 500. Your probability of making money is worse if you are just buying for appreciation. Again, this whole analysis is based on the fact that if you add in a 6% average cash on cash return, if you have amortization, it's better. And again, I did use these assumptions up here. So if you change those assumptions and made the cash on cash return 2% or amortization 0, like if you weren't using debt, for example, that would definitely change the results. I didn't run a million different scenarios. I thought these were pretty reasonable results, so I did this. The last caveat I want to say before I get out of here is that this analysis does not include 2023 data. And as of early 2023, the probability that you lose money this year in terms of property values is higher than most of the years in the analysis. So I do think that will change things, but honestly, not that much. I do think it will probably get things a little bit closer. But if you look at this analysis for how much money you make on average, it's really not really that close, 300 versus 520%. So even with a bad year in 2023 and 2024, I still think real estate would win, but I think it's important to caveat that and make sure you know that this analysis will probably change when I add in 2023 data at the end of this year. So I hope this was helpful to you. I had a lot of fun creating this analysis because I think there's always sort of this rivalry between real estate and stock market, and there's not necessarily one true answer. But for me, as a rental property investor who invests for cash flow and amortization and property value increases, I think this is really reassuring that the real estate market is a safer, it's a less risky, and a higher potential investment than just investing in index funds. Thank you all so much for watching. My name is Dave Meyer. Again, I'm the Vice President of Data and Analytics at BiggerPockets. If you have any feedback on this analysis or any thoughts or questions, you can find me on BiggerPockets or on Instagram where I'm at The Data Deli. Thanks again for watching. I'll see you next time.